Everybody is talking about the debasement trade, as in the US dollar losing more and more of its purchasing power, and that's the reason why Bitcoin continues to appreciate. It's also a reason why other assets continue to appreciate. This is a chart of Bitcoin over the very long term. This is a chart of gold over the very long term. But I don't think the reason for gold appreciating, I don't think the reason for Bitcoin going up is just because the US dollar is suddenly losing ground. Because when we compare the US dollar to other fiat currencies, it's actually not doing that badly. Have a look at this. This is the DXY. This is the dollar strength index. The dotted line is the average index value. This chart starts in 1967, and we are just at a level where we should be. We are not super expensive in the dollar. We are not super cheap in the dollar. There's nothing extraordinary here at all. And that's quite surprising, given that the debt to GDP in the US is at an all-time high. So the USA has never been that indebted relative to how much they're outputting every year. It's not just the debt to GDP, it's also the debt relative to the money supply. Because since the supply of the US dollar expands by roughly 6.8% every year, the debt also quote-unquote devalues. But spending outpaces that devaluation slightly, by 19% over the course of the last 30 years. I think it's much more important to look at ratios, not to look at US dollar valuations, not to look at how many US dollars do we have in debt, how many US dollars is our GDP, but instead at looking at what is actually the growth measured in a constant monetary base. Because the US money supply again grows by 6.8% per annum. This is over the course of the last 66 years, and it's relatively predictable. Have a look at the same chart on a logarithmic scale. This is almost a straight line. Sometimes we are accelerating a bit more, sometimes we are decelerating, but in general 6.8% per annum is a pretty reliable number. So relative to other fiat currencies, the US dollar is doing fine. There's no real problem here. I think the real problem is this. Stocks are incredibly expensive. Historically, we are at a price to earnings ratio of 41. So when we buy stock now, we are paying for the 41 next years of earnings. In other words, we have to wait 41 years until we get our money back. This chart is very long-term in nature. It starts in 1871. We had major crises in the past. This here was the Great Depression, which put pressure on the entire global system, which then led to World War II. Then we had a massive expansionary period during the technology boom in the 80s and 90s, then the dot-com bubble crash, then following the global financial crisis. This here is when Bitcoin was born. Bitcoin was born at the peak of the global financial crisis. It has never seen a serious depressionary period. So you really can't say what's going to happen with risk-on assets once the bubble pops. Now, what bubble are we currently in? It's probably the AI bubble, right? There's all of this investment into artificial intelligence infrastructure. If that will then turn out to be profitable investment is yet to be seen. All we need for a crash in prices is just a mismatch in timing. The internet is incredibly important. It has grown since the 2000s massively, but still we saw this crash because there was temporary overinvestment into the space. Many internet companies failed in 2000 and 2001. You've probably seen it right now, all the circular investments across the major tech companies that artificially inflate revenues. And even though the revenues are already artificially inflated, still historically we are at incredibly high price to earnings ratio. If you don't know what I'm referring to here, then feel free to check out the video by Patrick Boyle, Is AI's Circular Financing Inflating a Bubble? So the reason for Bitcoin going up, the reason for gold going up even more, it's not a weakness in the US dollar. It's not because the US's debt to GDP is that high. Instead, it's a lack of better alternatives. Have a look at the S&P 500 relative to the gold price. Stocks are still comparatively high relative to gold, even after this massive run-up in gold. This dotted line is the average ratio of the S&P 500 relative to gold. And while there is a case to be made that maybe stocks outperform gold very long term, I don't think that that's the major takeaway from this chart. Much more important is just the volatility. This is a crash of 86%. This is a crash of of 93%. This here is a rally of 3,000%. So really finding the right allocation between risk on and risk off assets, between stocks and gold, between property and Bitcoin, that's much more important and much more impactful than being idealistic about the right asset class, right? It's better to be opportunistic. When something is cheap, we just buy more of it. When something is expensive, we rather sell it. And it appears as if stocks are still quite expensive. It's not a dollar debasement trade. It's a search for alternatives since stocks are overvalued massively. Now, the bulls might be drawing charts like this. This is the Nasdaq 100 relative to the gold price. And of course, technology stocks, because of all the reinvesting, because of all the risks we take on, should outperform gold long term. So I do agree that this should be a long-term trending chart. I do not agree that there's a chance that we will see a similar rally to the 1990s again. I don't think there is any way that the Nasdaq 100 can outperform gold by another 1,000% from here. This is not the upper end of a trading range. We might already be very close to a turnaround. And here's why. There is a limit to growth. There's a limit to valuations. Have a look at the following. Let's check out the top tech companies. Nvidia, Apple, Microsoft, Amazon, Meta. Let's have a look at what their market caps are. Nvidia has a market cap of a bit over 4 trillion. Apple is also 4 trillion, so that's roughly 8 trillion. Then we've got Microsoft, another 4 trillion, so now we are at 12 in total. Amazon has 2, Meta has 2, so we are at 16 trillion just looking at those 5 tech companies. Now, what does 16 trillion actually mean? Here is what it means. Let's have a look at the money supply again, USM2. USM2 is at 22 trillion, so 16 trillion is making up the vast majority of the current monetary base. Is that ratio in any shape or form rational? Does it make sense that this is the top tech companies and this is all the rest? I don't think so. The more I look into the numbers, the more I feel like the data is intentionally skewed. Because, for example, the US GDP is measured in US dollars, but the base, the monetary base, is going up over time by 6.8% per annum. So obviously, today, people are not 3 times better off compared to the year 2000. That's what the US GDP wants us to believe, right? When people talk about GDP growth rates, they're just looking at US dollar growth rates. But since the monetary base is expanding as well, have a look at the ratio. This is the US GDP relative to the monetary base. Since the year 2000, people on average have it worse by 37%. If we look at the output of the US economy and we assume a stable monetary base, we don't change the monetary base at all. If there wasn't any monetary expansion, we would see the GDP decline quite massively. And intuitively, we all fear this, right? We all know that our parents had it much easier to buy the house, to put kids through education, to potentially feed the entire family just on a single income. Today, that's completely impossible. What also needs to be noted is that capital concentrates more and more over time. So the GDP growth that we see measured in US dollars goes to fewer and fewer people. So the broad majority of people see even more decline in their purchasing power. This here is just the average decline, but the median is much, much worse. Have a look at the US personal income over time. It looks good, but this number since 1959 grew by 6,300%, while the monetary base during the same time period grew more than that. That's 7,300%. Things just don't add up. Technology stocks are way too expensive. The GDP in constant dollars is going down, yet stocks relative to their earnings are at an all-time high. And stocks relative to the monetary base are also at an all-time high, at very similar levels to the peak of the dot-com bubble. And that's why we see the demand in gold. That's why everybody is buying different things to stocks. This is a demonetization of the stock market. This is not a problem that's intrinsic to US politics. The DXY is doing just fine. all fiat currencies have this problem. Here, by the way, is gold relative to the money supply. It's already above its historical average. Now, there's a very interesting misconception with altcoins. Have a look at this chart here. This shows total 3 ES divided by Bitcoin. Now, what does this mean? Total 3 is the market cap of all cryptocurrencies that are not Bitcoin and Ethereum. ES means that we also exclude stablecoins. So this is all of the volatile altcoins that are not Bitcoin and Ethereum. And we look at that market cap relative to Bitcoin's market cap. So how are the volatile altcoins doing relative to Bitcoin? And it seems like this is trading in a range in the last 8 years. If we just look at the prior year, we also seem to just performed in the same way as Bitcoin. But clearly that is not true. Have a look at the performance of these smaller altcoins in the last year. Pretty much everything is red while Bitcoin went up. The key to the puzzle is to understand the difference between market cap and price. This here is an example of WorldCoin. WorldCoin over the years saw an increasing market cap. It went from a peak of 1.5 billion to 2.5 to more than 3 billion. So WorldCoin tended to grow in market cap. But have a look at the long-term price chart. It looks very different. WorldCoin's price peaked at close to $10 and is now below $1. There can be a massive disconnect. In this chart here, it just looks at the altcoin market cap relative to the Bitcoin market cap. And this is true for many altcoin related metrics. It's true for the others market cap. It's true for the others dominance. It's true for dominance charts in general. When we look at the Bitcoin dominance or the Ethereum dominance, we are just comparing market caps. We are not comparing prices. Even when the Bitcoin dominance stays stable, Bitcoin very likely has outperformed most altcoins because altcoins might have been stable in market cap, but they might have gone down in price. This effect that we see for WorldCoin is very typical for altcoins. Now here's the circulating supply of WorldCoin. Again, just an example of what's going on with the market. We had 500 million WorldCoin at launch, and that more than 8x'd over the span of 2 years. When we look at the entire altcoin market, at least the tokens that are tracked by Tokenomics.ai, we've got weekly unlocks of roughly $1 billion. So if the demand for the altcoin market is below $1 billion, if the altcoin market doesn't grow that much every single week, then the price goes down. Because all of those unlocks, they are tokens that get allocated to the early investors of the altcoin projects. They get allocated towards the founders. They get allocated towards the insiders. So they are cashing out at a rate of 1 billion per week. And if the retail investor doesn't buy at the same rate, then price goes down. So here is an example. This is WorldCoin in US dollars. Here is WorldCoin relative to Bitcoin. So a much more consistent underperformance. Now there are two potential takeaways from this. The first one would be to just completely stay away from altcoins altogether. Altcoins are rigged, altcoins are through dump on retail investors. But the second potential takeaway is to maybe flip this thing around. So we are betting on falling prices of WorldCoin, while at the same time betting on rising prices of Bitcoin. So when we flip this chart, we get this here. This looks quite interesting, doesn't it? Since launch, Bitcoin outperformed WorldCoin by 836%. So that's the kind of performance we are looking for. The problem, of course, is volatility, especially here at the end. So WorldCoin occasionally does have positive news. It still has development. It's still an active project. And so a strategy like this can still lead to temporary drops of 55%. Despite the long-term outperformance. So the idea to bet on token inflation structurally is a good one. The idea to bet on falling prices when things look like this is a good idea. But risk management is crucial, and we have to look at assets that don't have that much more active development, where we don't see any positive news around the project anymore. Here's an example I like to give regularly on this channel. This is Bitcoin relative to Balancer. Balancer also has a high token inflation. And yes, there can be some drawdowns along the way as well, but they're not 50%, they're only 30%. And on a logarithmic chart, this looks much more manageable. And so this strategy doesn't just work in theory, it actually does work in practice. Let me show you how. When we look at this relative valuation chart of Bitcoin to Balancer, and we compare this to just buying and holding Bitcoin, so that's now the line in orange, we can clearly see how betting on the differential, so betting on falling Bollinger prices by betting on rising Bitcoin prices, has a way better long-term risk-adjusted return. And so I followed this strategy for the last 4 years. This is a monthly chart. Had I just dollar cost averaged into Bitcoin, I would have gotten the performance here in light gray. But because I also bet on falling altcoin prices at the same time, I got the performance here in black. Now the problem is, just because I make profit with that strategy doesn't necessarily mean that you have to make profit with that strategy. But I do believe in the strategy that anybody can mirror similar performance. What we've got over here is a copy trading vault. So the premium members of this channel had the possibility to invest in a capital pool. That capital pool is closed until the end of the year. But anybody that deposited in July of this year is now up roughly 20%, while Bitcoin since then went down in price. Of course, the massive market disruption that we saw recently helped us as well. It was actually the best weekly return ever. It brought us more than 9%. Most others got wrecked, but we made money. And so I made several videos on the topic. There's one video explaining the copy trading vault, but again, that vault is closed until the beginning of the year. But here are the two more important videos: using perpetual futures to bet on relative valuations, and risk management with relative valuation bets. Risk management is extremely important, because if you don't know how to do that, you get wrecked during volatile times. You don't make money. So here are the two videos. This is 34 minutes in length. Here's the other video, 28 minutes in length. And once you've watched those two videos and you've joined the premium groups, I will share my favorite trade with you. So the favorite trade will look very similar to the balancer trade that we looked at. If you are not making money with that favorite trade after holding it for 1 month, I will refund the premium membership fee to you. So really, you are not risking those $125. If you're not making money with the trade, you just get this refunded. I will not ask any questions. If you want to be part of the next copy trading vault and you don't want to make the trades yourselves, you simply just want to deploy capital, then feel free to check out this video over here. This was the introduction to the vault from July. And feel free to consider to sign up for the annual membership, because the yearly subscribers, they get access to that copy trading vault that currently is closed. Of course, you can simply start out with monthly, start the trading yourself, and then swap to the annual membership later on. A link to premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.